and decode the numbers with Mr. Amitabh Chatterjee, the Deputy Managing Director, Canfin Homes. Hi, sir. Thank you so much for making time and speaking with us. Well, the loan book has grown by 20%. Disbursements and approvals are a tad bit lower. Talk to us about the trends that you are seeing. Is demand still strong? Is there loan growth target or guidance that you have in mind for the coming quarters?
See, our disbursement are in line with the projections which we have given earlier. Demand is still intact and our loan book has also grown. And if you compare last year with this year, last year a lot of pent-up demand was there. So that reflected in the last year book growth and demand disbursement growth. So, but as we feel there has been Q on Q, there is a disbursement growth is there and book growth is there. And we still feel that demand is intact and it will continue to be so in the remaining quarters also.
So is there a loan growth target guidance owing to forward Q4 23, FY24? What's the basis of demand?
Yes, we are targeting a growth of 18 to 20% in loan book as well as disbursement.
That makes sense, 18 to 20% growth as far as the loan book is concerned. But understandably so, your cost of funds has risen faster than yields. How quickly are you expecting yields to rise now, and what's the timing of your interest rate reset that we can expect?
See, growth, this cost of funds have gone up because of our rise in the cost of borrowing, because RBI has hiked the repo rate by 2.25%. Accordingly, our lenders have passed the hike to us. And we have also increased our rate, but difference is that our rate of interest is it at annual reset. So slowly from now onwards, we feel that our NIM and spread will improve, given that major chunk of loan book will be reset in the coming quarters.
So if my understanding is correct, there is a 1-year lag between the two. So could you give us the understanding or component of your book that is fixed and component that is floating, both asset book as well as liability side?
See, I think all borrowings are at a floating rate, and accordingly, around 99% of our book is at a floating rate.
So when I was going through your numbers, I see that the asset quality is quite stable, plus the provisioning has come off on a sequential basis. Should I read this to believe that you're not too worried about the asset quality, as well as there wouldn't be a need to increase the provisioning, at least in the near term?
Yes, our stable quality, our asset quality is stable, and going forward, we will not see much increase in the provisioning.
So you have about 190 branches. You're growing at about 18 to 20%. What is your branch count also growing at? Talk to us about how one should see your branch count over the next 4 to 5 years.
See, we have got 13 satellite offices, which we are planning to upgrade in the coming years. Apart from that, we are projecting around 5 to 7 branches per year to be opened.
Okay, so not a very aggressive target when it comes to branch opening, but your cost to income ratio is relatively low. What's the secret sauce there, and how is that expected to trend going forward?
See, cost to income ratio is stable because of the cost of borrowings, and we feel it will be around 16 to 80% in the coming days.
Despite your growth, you will not grow your branch count meaningfully. Why is that?
See, we are having branches across north in all major cities, and south is well covered. But what we feel that we need to leverage the existing branches where we feel that potential is still there. So we are not going to increase our cost by increasing the number of branches, but we'll definitely leverage the existing branches so that we can derive the maximum benefit out of it. You see, our business per branch has increased from 130 crores to 145 crores. And going forward, we'll be increasing to 160 crores.
We'll let you go on that note. Thank you so much for joining us and talking to us about how the outlook is looking like. Taking a short break on the show.